Okay, so we have been doing inventory costing methods. That's what we did yesterday, and that was in a perpetual system. You remember at the very beginning of getting into retail businesses, I mentioned that a perpetual system is one where we record all increases to our inventory kind of as they happen, and all decreases to our inventory as they happen. So we're constantly just adding and subtracting things from inventory. This is what most businesses do now because in the modern era, almost all businesses use computers and they have barcode scanners. So it's real easy. I get 12 items, I put in quantity 12, scan the barcode, and they're entered into my system. And then when people check out, I scan them out and they're withdrawn from my system. But there are still some smaller businesses who use what's called a periodic inventory system. So we at least have to look at the concept of it. So that's what we'll look at today. So when we use a periodic system, we just record the revenue whenever we make a sale, and we don't worry about the cost of goods sold with each sale. Instead, we're going to calculate the cost of goods sold at the end of the period. That's why it's called periodic. Many businesses do this just like once a year, actually, where they just kind of calculate, but more often once a quarter. Okay. What's that? Yeah. They have an end of year inventory they have to do. Okay. Yeah. So I grew up in a store. My mom owned a store, and we had to do inventory every year. And like legitimately, it was like me with a spiral bound notebook, the same one we used every year. And I would like go and like be like Del Monte peas, 12. Del Monte corn, 6. Like for every item in the store, sucked. Okay. And I was making a solid minimum wage, solid 5.50 an hour though. So pretty good. And it had to be done. And so what we would do is we would keep track of our purchases throughout the year. And then at the end of the year, we would count how much we had. So we would start with the number from last year's inventory, which would be the amount we had at the end of last year, which by the way is the same as the amount we had at the beginning of this year. We'd add all the things we purchased, and that would give us the total, what was called the cost of goods available for sale. Then we would count how much we had this year and subtract that from what was available for sale, and that would tell us how much we sold, right? So the pattern was beginning of the year plus anything added minus what we had at the end of the year is what we sold, okay? So you do that for every item in the store, and there's a reason like computers are better, right? Because like it's better to do that. We still have to do end of year inventories even with a perpetual system, but it's just so you can do that adjusting entry because you're going to count them up and be like, oh, we're missing 4 cans of peas. Where did those go? Well, they probably got stolen, or one got dropped and cracked open and you threw it away, or there was shrinkage. So anyway, so this is what the periodic system's about, and so that's what we're going to cover in the second part of chapter 6. I would like for that 1 to disappear. I'm aware. All right. So the way we would do first in, first out with the periodic inventory system um, is here we have an item. They call it item 127B. I don't know what the item is. It's item 127B. And we have the beginning inventory in January, and then the purchases during January. So we would know that during the month, if we started with 1,000 and we purchased 500 and then 600, we would know we had 2,100 available for sale during the month, and the total cost of that was 45,180. So we get to the end of the month, we do a count. Shows we have 800 units left, and we're still going, well, which of those units did we sell of the 2,100? And so the answer is with first in, first out. Remember when we did the perpetual system, each time we made a sale, we had to figure out which ones are we selling. With this, you just get to the end of the period, and then you say, well, with first in, first out, we're going to assume we just sold with their 2,100 units, and we had 800 left. So we're going to assume we sold the 1,300 oldest units, and that the ones remaining are the 800 newest units. So it's very similar, except we don't update the inventory each time we make a sale. Instead, we just keep track of our sales, or we keep track of our additions, sorry, our purchases. And then at the end of the month, we calculate what our cost of goods sold was and what the value of our ending inventory is. Okay. So very similar, slightly different. So beginning inventory 20,000. We had purchases of 11,200 and 13,980, which gave us cost of goods available. Our ending inventory was worth 18,460. So the cost of goods available minus the cost of the ending inventory gives us our cost of goods sold. Okay. It's a little bit more mathematical and a little bit less like counting each time we do it. All right. We'll do some examples and you'll see it's not bad. What's hard about these problems then is you have to pay attention when you're looking at the problem. Does it say periodic, where I'm doing everything at the end of the month like this? Or does it say perpetual, where I have to keep track of I have to redo it with each sale? That's the hardest part, is recognizing which one are we doing. In real life, businesses use a consistent method. So if they use periodic, they always use periodic. And so you just know. Or if you use perpetual, they always use perpetual. So it's actually harder in class because it's like a word problem and you've got to look for a key term, perpetual or periodic, in the problem. Okay. And just so you know, we'll introduce periodic in this chapter, and then we won't mess with it much more. We'll assume perpetual going forward. So this is just saying you may see this out there if you ever work on bookkeeping or accounting, but most businesses use perpetual systems now. Again, it's rare. It would usually be a business that just doesn't move a large volume of, like say it's primarily a service business, but they sell some stuff. They'd be the ones who would probably use this periodic system, because it wouldn't make sense to invest in a whole computer system when they only sell 20 items a year or something. All right, so let's look at question number 1 in the guided. So here we have the periodic inventory system by 3 different methods. So this, we're actually going to look at first in, first out, last in, first out, and the weighted average method all in this one problem. So here's the item. We had 180 units that we paid $108 for. On March 10th, we purchased 224 more. August 30th, purchased 200 more. December 12th, purchased 196 more. And then there's 208 units at the end of the year. So we're supposed to figure out, well, what's the cost, right? And what's the cost of goods sold, and what's the value of the remaining inventory? I'm gonna bring this, I'm just gonna use an Excel spreadsheet to maybe show this to you. All right. And I'll make this a little bigger. So first, I'm just going to take this same information. I'm going to say on January 1st, I had 180 units that had a cost of $108. March 10th, I purchased 224 more units. So I'm just recopying down the information from the problem right now. August 30th, bought 200 more units at 116. And on December 12th, I had 196 units, or I purchased at $120. So that'll be date, that'll be units, and that'll be cost per unit. So is that big enough for everybody to see, or is it still pretty tiny? Does that help? All right, so that's just the same information they gave me in the problem, right? So what I can do is first, I'm going to add another column here, and I'm going to put total cost. You could do this on paper too, or with your calculator or whatever, however you want to do it. But my total cost is just the number of units times the cost per unit. And I'll do that for all of them. And then down here, I can find the total cost of goods. This number is told the total cost of goods available for sale. In other words, what I had at the beginning of the year plus everything I purchased is what I have available to sell during the year. Okay. And I can have the total number of units available for sale. So I had 800 units available to sell during the year, and they had a total cost of $90,800. This tells me that there's 208 units at the end of the year. So how many units did I sell during the year then? If there were 800 available, yeah, so it's just 800, the number available at the beginning of the year throughout the year, minus the number left at the end of the year would be the number I sold. So I sold 592 units this year. So then we're finally at the heart of the question, which is, well, which units, if you're trying to figure out the cost, right? So there's two ways to go about it. I could say, I'm just going to, since I'm doing first in, first out, I'm going to assume it's the oldest 592 units. So all 180 of those, plus all 224 of those, plus however many more of these it takes to get up to 592. Does that make sense? The other way I could approach it is say there's 208 left at the end of the year. So it would be the ones that are left over at the end of the year are this whole 196 plus another 12 of these. And that would give me the cost of goods still in inventory. And then I could subtract that from the total cost to get the cost of goods sold. So I could approach it from either direction. Okay. So with first in, first out, I'm going to assume that if I sold 592, in fact, I'm going to do a little total. I'll show you just one way to maybe consider doing this. So I'm going to say, I know I sold 592 items. With first in, first out, I'm going to assume the oldest ones. So I sold 180 of those, of the oldest ones, the ones that were there on January 1st, and another 224 of the ones in March, which takes me up to 404. And then if I were to sell all 200 of these, that'd be too many, right? So I actually only sold, what would that be? 188. So what we're saying is, if I sold 592 of them, which ones did I sell? Well, I sold all 180 of the January 1st units, plus 200, all 224 of the March 10th units, plus 188 of the August 30th units. Does that make sense? That adds up to 592. So to find my cost of goods sold, then I would just take the number I sold times the cost per unit. Again, you could do this by hand. You don't have to use Excel if you don't want to. So my cost of goods sold was $65,888. Now I know if my total cost was 90,800, the total cost of goods available, and I sold 65,888, then the cost of, or the cost of the goods in ending inventory is just going to be 90,800 minus what I sold. That's what's still left over at the end. That makes some sense. Like not too crazy and not too fast. Yeah, okay. So let's look at if we were to do this last in, first out instead of first in, first out. So with last in, first out, we're going to assume that we sold the newest units, right? So I'm going to assume I sold all 196 of these. Those are the newest ones. Those are the ones that we purchased on December 12th, and that we sold all 200 of the ones that we purchased on August 30th. And if we say we sold all of those, well, that's too many. So we're going to have to say we didn't sell all of those. We sold 196 of those. So do you see what I'm doing? I'm just assuming with first in, first out, I sold the oldest ones, and assuming with last in, first out, I sold the newest ones. Okay. So again, if I multiply this out then and say at $110 each times the 196 I sold, then my cost of goods sold is 44,760. And then I take 90,800, which is the total cost of goods available, minus the cost of goods sold, gives me the cost of goods in ending inventory, or 46,040. Finally, the last strategy is simply to take the weighted average. To do the weighted average, all I would do is just find out an average cost. So I would say, well, I had 90,800 units available, and I had 800 units. So my average cost per unit is just 90,800, the total cost of goods available, divided by 800, the total number of units. And that gives me an average cost per unit, $113.50. And then I just say, well, if I sold 592 of those, then my cost of goods sold would be 592 times 113.50, 67,000. That seems high. What did we do wrong there? Okay, well, let's finish this one, and then we'll go back and look at last in, first out and see what I made a mistake somewhere. Should have used a check, huh? So there's the average. So 67,192 is my cost of goods sold. And then again, I can just take 90,800 minus 67,192 gives me 23,608. So the reason it looked funny to me is the weighted average should come out somewhere in the middle, typically between first in, first out and last in, first out, in a situation where my costs are rising like that. So let's use a check since we have unlimited checks. And then let's figure out what we did wrong here. So we sold 592 units. So again, we're going to assume we sold all 196 of those, all 200 of those, and then we sold 196 of those. Whoops. Yes, and maybe I didn't include all three of these lines in the sum, because I just used the same process, right, and got a different answer. So I made an error of some sort when I was doing it. So again, we had to figure out which 592 we sold. We sold the oldest, all of the oldest ones from December 12th, all of the ones from August 30th, and 196 of the ones from March 10th. Add those up, we get a cost of goods sold of 68,280. And then if we take 90,800, the total cost available minus the cost of goods sold gives us the value of our remaining inventory, or the cost, not the value. So that was probably just an error of me not including all of those lines in my sum. So the only difference between this and the perpetual inventory system is we're just doing this all at once at the end of the period. In this case, their period was the month of January. Okay. With perpetual, we would have each time we made a sale gone and looked at what we had in inventory at that time and assumed, like with first in, first out, that it was the oldest of what we had in inventory at that time, and then added any new purchases, and then gone back with the next sale and said, well, which ones did we sell? With periodic, we wait till the end of the period, and then we just take the oldest if it's first in, first out, or the newest if it's last in, first out, or the average cost if it's average. Okay. So this is part of what makes it hard, is they're very similar, but a little different, right? And so you have to identify which one you're doing and then apply the correct rules. That I always think things that are too close together are the hardest for me to learn. So like if they're completely different, it's easy. All right. So any questions on that, or anything you want me to work over or explain better? I know it's hard because it's like, I don't know what I need you to explain yet until I'm doing the work. I know. That's life. Okay, then let's move on. Maybe. All right. So another question comes up. So remember, we track our inventory on our records at its cost. That allows us then, when we sell it for some price greater than our cost, to easily calculate our gross profit. Typically, when we're trying to be, one of the principles of accounting is that we're going to be conservative in what we do, meaning we're not going to make crazy estimates. We're going to base our estimates on something on more conservative. And so if we carry things that are at their cost on our books, and then the value of the item goes way up, conservatism kind of dictates that we still keep listing it at the cost, at the lower price. But if the value of it drops way down, like let's say I've got a whole inventory of iPhone, 14s, and now they're releasing a 3 generation later one, the iPhone 17, to assume that the value of those iPhone 14s isn't going to drop some when everybody can go get the new one, well, that's not really being conservative. I'm carrying it on there at the price I paid for it, even though it's actually worth quite a bit less than that now. Okay. So there's a rule that's based on this sort of desire for conservatism in accounting that's called the LCM, or the lower of cost or market rule. This calls it the low of cost or market method. And in essence, what it says is we should carry our assets, our inventory assets on the books at the lower of the cost or the market value. So if the market value drops below the cost, we should adjust that value down. And that means, so the term they use is the net realizable value of the inventory, meaning the value that we can actually realize by selling it, that we can get by selling it. And so the net realizable value is just the estimated selling price minus the direct cost of disposal. Don't worry too much. There's lots of situations and lots of things that can be direct costs of disposals when we do these problems, because again, we're doing it in a fixed textbook sort of setting. It's going to have to give you this information so you can calculate it. So this shouldn't be a super hard thing as long as you know that really basic formula there. Okay. So the direct cost of disposal, Like I said, there's tons of things that could fall into that category, but they're just the selling expenses or anything you have to do to sort of move this old inventory, right? If we had a bunch of iPhone 14s and now that the 17's out, we decide they've dropped in value, we may say, in order to sell these, we're going to have to offer a special deal to people, right? So there's going to be some marketing and other costs involved in disposing of or selling, getting rid of this inventory. So here's some data they give us. The original cost is $1,000. Now the estimated selling price is 800 and the estimated selling expenses are 150. So to apply the lower of cost or market rule, we're going to call the market value of the inventory 650, which is the net realizable value of 800 selling price minus the 150 it's going to cost me to sell it at that $800. So reasonably, I can get $650 net out of these items that I paid $1,000 for. Stinks, but that's part of business sometimes. Okay. So we're going to mark the inventory down then to the lower of the two. And since the cost was 1,000 and the net realizable market value is 650, we're going to mark it down to 650 on our inventory. This is so that investors looking at our company and thinking of investing money in us don't think we have more assets than we actually have. If we're listing them at our cost, and let's say we have 1 million units of it, it's going to look like we have way more assets than if we listed at 650 per unit, right? So it's meant to be fair to investors by carrying it at the lower of the cost or the market value. So let's look at an example of it. Whoops. All right. Based on the data below, how would the inventory appear on the balance sheet, assuming that the lower of cost or market is used and the cost is determined by the first in, first out method? So our total cost is 248,000. The total market value of the asset is 252,350. And then the lower of cost or market is 239,350. Remember, that means the market value minus any direct costs of disposal, right? So how we list that. So the inventory would appear in the current assets system, or sorry, section. That's what inventory is. It's a current asset, an asset we expect to convert to cash in the near term as follows. Inventory at I don't know what they want there. That's a little weird. Let's see what they want there. I don't know why they have it that way. Okay. So they want us to put the inventory at lower of cost, first in, first out method, or net realizable value. Never have I ever seen a balance sheet that lists all of that. It usually just says inventory, and then there's a little asterisk that says C note, and you go down to the note, and then it explains all this information to you at the end. Anyway, and that's going to be at this lowest price. So all we really need to know for this concept is that inventory is carried at the lower of cost or market, and the LCM rule or the LCM method requires that to find this LCM price, we take the market value minus any direct cost of disposing, which could include, as we said, special selling costs or anything like that. That's all. Piece of cake. All right, one last concept here. You'd notice that most of these chapters, they introduce at least one of these financial ratios to you. These are ratios that we use to help us make more sense of the financial data of an institution. And so, maybe we saw the current ratio before, which was the current assets divided by the current liabilities. That just helps us compare items on the balance sheet in a way that tell us something about the business. So in this chapter, they introduce the idea of inventory turnover, which has to do with how quickly we're selling our inventory, which is the cost of goods sold divided by the average inventory. And then the other is what's called days sales in inventory, which is the average inventory divided by the average daily cost of goods sold. So again, we'll look at, so let's remember these: inventory turnover, cost of goods sold divided by average inventory. Anybody have a guess how we would find average inventory? Yeah, well, yeah, because it's like inventory is at any given moment, right? So usually what you do is you take the inventory at the beginning of the period that you're measuring for, the inventory at the end of the period, add those two together, divide by 2. That gives you an average of the inventory. It would be a better average, of course, if say it was over a year, if you took the inventory each month and divided by 12. But the standard is to just take the beginning and the end, divide by 2. That's the average inventory. We've already seen another one where we used an average like that, right? So that's inventory turnover. And then days sales and inventory is the average inventory divided by the average daily cost of goods sold. Or sometimes we write this as cost of goods sold per day, which would mean take the year's cost of goods sold and divide by 365. That would give you a daily cost of goods sold. All right, so let's do a problem with it. And these numbers are actually super helpful when you're looking at the health of a business, which is why we use them. If I can find it. There it is. All right, so here's inventory turnover, number of days sales and inventory, financial data for the Tango company. I wonder what they sell. Or it could be Tongo, depending on where it's at, right? Um, so we have the cost of goods sold, and then we have the inventories at the beginning of the year and the end of the year. And they want us to determine the inventory turnover for 2017 and for 2016. All right. So inventory turnover is just the cost of goods sold divided by the average inventory. So, whoops, I could use this, right? I could say 2017, 2016, cost of goods sold is 3,864,000 and 4,000,000. And then inventories, the beginning of the year, and end of the year. For some reason, I want it to look like dollars, but I'll get rid of the decimals. All right. So again, that was just me copying over the data, right, from the problem. So my average inventory then would just be, for 2017, it would be the inventory at the beginning of the year plus the inventory at the end of the year divided by 2, right? And I could do the same thing for 2016. All right. So if my turnover is my cost of goods sold divided by the average inventory, then I would just say turnover equals the cost of goods sold divided by the average inventory. All right. 4.8, 5.3. Check our work. So what does this mean? This means that I sold an amount of inventory equal to my average inventory 4.8 times during the year. Or in other words, I sold 4.8 times the amount of my average inventory. So turnover means every time we sell an amount equal to our average inventory, that's one, they call it a turn. It's like I sold the whole store. But in reality, you didn't sell the whole store because you might have some stuff still sitting on the shelves and other stuff that you sold and bought some new stuff and sold again. But in dollar terms, I sold an amount equal to my average inventory. That's one turn. So if I have an inventory turnover of 4.8, it means I sold an amount equal to my average inventory 4.8 times during the year. Stores like Home Depot, their goal is 12 turns. They want to sell an amount, so they want their sales to be 12 times their average inventory, or selling an amount equal to the average inventory in that store 12 times in a year. That's their goal. Okay. And then the number of days sales in inventory. So I'm going to call that days sales in inventory, or DSI. The formula is the average inventory divided by the cost of goods sold per day, or, whoops, average inventory divided by cost of goods sold. And this is, since this is for a year, divided by the number of days in a year. Does that make sense? So what we're saying, and what is it going to tell us to round to? And it tells us use 365 days and round to one decimal place. Some older texts and some businesses still use what's called the 360 day convention. They assume 360 days in a year because it's way easier for the math to just assume a year is 12 30-day months. But because we have computers now that make that so easy, most use 365 and do it right. All right, so day sales and inventory 76.0 for 2017 and 68.9. Let's see if it likes our math. It does. What this means is, on average, $1 of inventory stays on our shelves for 76 days in 2017 and for 68.9 days in 2016. Again, we're not speaking to any specific inventory item. This is like an average. Okay. So what we see then is that this business is slowing down. It's not selling its inventory as fast. If it took 68.6 days to sell inventory on average in 2016 and 76 days in 2017, we're slowing down. That's not a good thing typically. Okay. So are the changes in inventory turnover and the number of days sales and inventory from favorable or unfavorable? I'm going to say they're unfavorable because it's taking us longer to sell stuff year over year. And that's it. Everybody's putting their stuff away. We still have 3 minutes. Go to 2. Why are you guys so eager today? Got hot dates? Where do you want it? All right. Bye. Miss you. That is all I have for today, though. So sorry. So have a great day.